Listen, like it or not, we cannot escape the economic realities of a storm brewing. True, gold did pull back to about $2,500 per ounce, and now it's heading towards $2,700 per ounce. Why the sudden surge? Well, job numbers came in. They were about the poorest we've seen in almost 4 years. Inflation numbers came in, and it looks like price pressures are back. So, what's going on? Let's dive in. Inflation picking up speed while the labor market is weakening is not the news we want to hear. Should we be concerned about stagflation? Certainly, the analysts at the Kobesi letter think so, and they are sounding the alarm. The Fed's worst nightmare has begun. We now have multiple rising inflation metrics with signs of a weakening labor market. For the first time since September 2022, both CPI and PPI inflation are officially back on the rise. Did the era of stagflation just begin? Just the day before, the Labor Department reported that the annual core consumer price index stayed stubbornly at 3.3% last month, while the core producer price index jumped to 3.1%. The Kobesi letter also noted, for the first time since April 2023, core PPI and CPI inflation are back above 3%. Even as the Fed thought inflation was heading to their 2% target, it obviously is not. Inflation has clearly leveled off above the Fed's 2% target, yet they keep cutting interest rates. And just when you thought things couldn't get stranger, yields rising while the Fed is cutting rates. This is the opposite of everything I learned during my economic training. Talk about mixed messages. Over the same period, when the Fed lowered rates by a total of 75 basis points, yields actually jumped by 79 basis points. This suggests the market isn't convinced by the Fed's approach to inflation. Signs of a weakening labor market are also piling up. Last month's jobs report showed the economy added just 12,000 jobs. Even after accounting for hurricanes and the Boeing strike, factors expected to disrupt the numbers, analysts still anticipated over 100,000 new jobs. Moreover, October marked the fifth consecutive month with the unemployment rate above 4%. Job openings also fell to their lowest level in more than 3.5 years. Adding to the concern, the Kobesi letter noted, U.S. temporary help services jobs are down over 145,000 in the last 12 months, to their lowest level since October 2020. This is considered a leading indicator for the unemployment rate. Temporary help services jobs have shrunk for 23 months, the longest stretch since 2008. If you were wondering if our trusty Federal Reserve was on top of this economic whirlwind, check out what Fed Chair Jerome Powell had to say on November 7th at a press conference. The whole plan is not to have stagflation, so we don't have to deal with it. That is actually our plan. If only wishing made it so. Analysts suggest this odd reply is the Fed suddenly admitting that they are unprepared to handle stagflation. As analysts at the Kobesi letter put it, this is a nightmare situation for the Fed because it puts them in a lose-lose situation. If you raise rates, we head into a recession. If you cut rates, inflation rises even further. The almost comical nature of Powell's approach elicited this reaction from economist Peter Schiff. Powell just said the Fed's plan on how to deal with stagflation is not to have stagflation. Then he laughed. That says it all. Sell your dollars and buy gold now while you still can. I've been keeping track of Peter Schiff for decades, and him suggesting that gold is the cure for stagflation isn't some off the cuff remark. There's actually data behind it. History shows that during the stagflation of the 1970s, gold and silver were among the best performing assets in the US. According to research by the World Gold Council, since 1973, stagflationary periods have been most supportive for gold and the worst for risk assets. We can't escape economic realities. They persist even during leadership changes. Just like a massive ship cannot change course quickly with a new captain, it takes time for our economy to adjust. That's why it's crucial to understand where we are today and prepare accordingly.